Welcome to the Monocle Banking Podcast, as always, curated by Monocle Solutions. Well, it's that time of year where we dust off the old crystal ball. We also look in the rearview mirror. And this week, we're asking, what have the big themes been that have shaped insurance during 2026 and how to prepare for what's coming next? My guest this week is the CEO of PSG Insure. Well, the first half of 2026 has provided a rather brutal reminder that South Africa's risk map is being redrawn in real time. We see increasing floods and storms and fires replacing grating pressure on property insurers. Motor claims remain the everyday workhorse of the industry, but the cost of repairing a vehicle is rising sharply. We see aging public infrastructure turning local failure into business interruption claims. And then we've got all of the offshore geopolitical shocks traveling through the oil price and freight rates and imported parts in the rand. And all of that happening while everyone is talking about AI. So the common thread really is that exposure appears to be growing faster than the protection we hold against it. Well, today we're asking exactly what we can learn from the first half and how businesses can build more resilience into the rest of the year. And joining me is Cedric Masondo, the CEO of PSG Insure. Cedric, welcome to the show. Before we start ticking off all of the big crises that have happened, from floods to motor claims and cyber attacks, just give us the overview. When you look at the first half of the year, are we simply experiencing a bad run of claims, or do you believe South Africa has actually entered a structurally different risk regime?
Good afternoon, and also good afternoon to your listener. I think you've summarized it nice. The first 6 months it's been a reminder that we're living in the world where there's ever changing in terms of climate change and also just some of the risk areas that we're seeing. So the first 6 months, especially for the people who were living in the Western Cape, was quite a big event. I mean, we had massive floods in the Western Cape, and that is something that we've seen it for years coming. So if you just look at the last 10 years, there's no doubt that changes in climate has had impact on all of us. We're seeing an increase in frequency of floods and just the impact. I mean, and that's what I will summarize it. And apart from just the increase in cost of repairing a vehicle, which is probably driven by just the supply chain. I mean, increases, parts are coming from all over the world if there's a war, and it always have an impact on motor vehicle parts.
Now, when you say, and weather-related catastrophes have become the largest force on claims costs this year, what does largest force mean in practice? Is it the frequency of the claims, the severity of individual claims, the total rand value, or is it the fact that the losses are increasingly correlated and arriving in clusters around these climate events?
I think I will be more leaning towards your third one. And I think we're seeing this in clusters. I mean, and not just the frequency increase, but just in clusters. When there's flood, it tends to be big and affect most areas. If you just go back last year in the Gauteng areas, I mean, it was raining almost every day in the summer and causes a lot of damages and the floods and so on. And in the Cape, we didn't have much floods in the last 2 years. But the last 6 months, we've seen just massive floods and in a specific area. And I think that is the main issue. We're just seeing an increase in just severity. Severity is becoming a problem and unpredictable. And the scientists are predicting that we're moving to El Nino, which might be prolonged drought or increase in heat. And sometimes during the El Nino, we'll just have those massive floods periodically.
And as an insurer, how do you disentangle the climate change drivers from everything else? And maybe rephrase that. I mean, how much of the increase in losses is actually from that changing climate, a more dangerous, more variable climate? How much is simply that we've built maybe more expensive assets in vulnerable places, or we've failed to maintain drainage and roads at a local government level, and then we've watched replacement costs rise? How do you disentangle the two?
Maybe let me start with the infrastructure because it's quite big. I mean, so in some areas, it's not like there's a massive increase in floods, just that the infrastructure is failing us, the drainage is not working and so on. So I think that's a problem that can be resolved by just making sure that everyone at municipality level, they do their job, the infrastructure is well maintained, drainage system is working. That does contribute a lot. And secondly, there are areas where people are building in areas that we shouldn't be building, and you find those areas are mainly affected. So those areas, I think these are our own goals. We shouldn't be having those things. We should be maintaining our infrastructure. We should be able not to enforce the bylaws and not allow people to build in areas that we shouldn't be building. But the insurers collect data, and I think the insurers are more the underwriting, or from the underwriting, risk selection, pricing. It's really advanced compared to 30 years ago when I started. So insurance collect data, analyze data. They have a fairly good idea the areas that are prone for droughts and areas that are dangerous. And not really 100%, but I think most insurers are moving towards that, the geocoding, where every address is coded and they can see exactly the frequency of rain, how the area is. And that really helped them in terms of risk selection, because insurance, there's nothing you can do in terms of floods or whatever. That's going to happen. But what makes the insurance differ from another one is just your risk selection and your pricing. And in the
Yeah.
last year, insurers have really built those skills, those capacity, and also their balance sheets.
That's fascinating to me. The fact that we're now using this geocoded climate data, spatial analytics, and that kind of thing. I mean, from what it sounds like, we almost have the ability to move from maybe pricing a broad suburb or municipality to pricing virtually street by street or building by building. Is that accurate to where we're kind of moving
No,
with how we price?
yeah, in fact, I think we'll end up moving to a house level, and where we can price the risk depending on the where their house and so on. I mean, that's what other insurers are doing on the motor. They price individual drivers, so they date how much you drive, how do you drive, what time do you drive, and then they price you on you as a person, not just like on the car or suburb. I mean, and I think on the property business, we're moving towards that area. Some insurance companies are a little bit advanced and some are studying it, but eventually all insurance companies will have that data because it's quite critical.
That is fascinating. Obviously, it raises all sorts of interesting questions because obviously the actuarial answer might be perfectly rational. The house is on a floodplain, or the property is exposed to wildfire, and the risk is too high. But if every insurer reaches the same conclusion, does the customer effectively become uninsurable through maybe no fault of their own? I mean, are you already seeing parts of South Africa where cover is becoming materially more expensive or more restricted or more difficult to obtain on the back of this?
Yeah, I don't think we've reached a stage where insurers are de-risking completely and not writing, but I am seeing areas where the pricing it's a little bit high. There's more restriction. Insurance companies require more risk management. They require some of the insureds to do more things in terms of risk management. I mean, just the typical example is thatch. I mean, if you look at the thatch
Yeah.
as a risk, I mean, this is not a secret. Everyone can see it. It's quite expensive to get thatch cover, and there will be a lot of restriction that the insurers will want. So I think we're moving towards that. Insurance is a business. You want to protect your shareholders' balance sheet. You're not going to write a risk where you're 100% sure there's going to be fire, there's going to be floods. So we're going to move to that area where clients with those type of business or areas, living those areas, will have to do a little bit more in terms of risk management.
I certainly discovered that firsthand in buying a new house with a thatch roof, how difficult it was to get a homeowner's cover. It wasn't impossible,
Yeah.
but the forms and
Yes.
things you've got to jump through in order to get that. I know the Prudential Authority has also previously pointed to catastrophe-related restrictions and exclusions in particularly exposed areas. Would you say we need to start thinking as a country about potentially having the state needing to become an insurer of last resort in some areas? Or do we simply socialize risks that property owners and municipalities fail to manage if we go down that route?
So I think there's no doubt there's a role for a state insurer that operates like SASRA, that deals mainly for the catastrophe and so on. But that doesn't mean that we must not do what it's supposed to be doing. Municipalities still need to maintain the infrastructure,
Yeah.
enforce the rules, because what's the point of wasting money and enforce the rules? There are areas where people shouldn't build, and there are cases last year where there was floods, and you go back to the history, people should not have built in those areas,
Yeah. Yeah.
by laws, so that doesn't remove everyone from performing their role and whatever, but there is a role for a state insurer where there's a misalignment between supply and demand. And I think agri drought cover for emerging farmers is a typical example. where it's almost impossible for a small farmer to get a drought insurance. So that's what you need in those cases. Or in some cases where people just can't afford insurance. And that there's also a role for the state.
Especially when you look at government policy and getting government policy to be aligned across multiple different areas. If you as government are saying we want to support emerging farmers, then one has to look at the role there of, not only the land bank, which has its own issues, but then, what role a state-backed insurer could play there as well. I want to stay with the municipal failure for a little while longer. And obviously, we've now seen, the Treasury's intervened, withholding the equitable share to 69 municipalities, among them the city of Johannesburg, the engine room of the South African economy, almost 1/5 of GDP generated in this metro. Where is the municipal failure now showing up in the claims book for you, Cedric?
So there are three areas where so the first one is an obvious one. Roads not maintained properly. I mean, a small pothole or big pothole, depending how big, causes damage to your car. Then you have to claim from the insurance because your rims and so on. So that's one area where, if you look at it, we shouldn't have those claims, but there's frequency of those claims because of potholes. And the second one, it's just flood, water drainage not working, and some areas being flooded that they shouldn't be. And then the last one, which worries me, and it worries almost all insurance, is the availability of water. So there will always be fire, but if we have a problem with water supply, almost 100 guaranteed water supply, it means that there might be a fire. As an insurer, you take an assumption that the building will be safe because there will be people fighting fire. But if there's no water, then your building might be banned to 100% banned. So that's a big worry, this water supply, and making sure that there's always supply of water, and especially in manufacturing areas.
Wow. So how do you as an insurer then price private property risk or private business risk when so much of that risk might sit outside of the property boundary and inside a municipality that the policyholder certainly can't control?
So I think the insurers have not, strict on this one. And I remember a long time ago when insurers used to price the risk per the code and postal code, and that had impact on the ability of that municipality to fight fire. So the urban municipalities had a better rate than rural municipalities.
Yes.
I think we will move to that area, but that assumption that we used to have it of Johannesburg Municipality Bank, I don't think it's something that we can generalize now. So we might have to really look at the whole municipality and how the municipality is structured. But I do think that the water supply is the biggest threat that's going to be a problem at an insurance level.
And it's interesting because I think insurance pricing could eventually become one of the clearest market signals of which municipalities are working and which are not. Because clearly, insurers have data on floods and burst pipes and all of that. And that could be used, I guess, more actively in public planning as well. Are you having discussions with local authorities about this at all? Maybe at a national level with SALGA or with direct municipalities? Or is this not something that you as PSG Insure are doing, maybe the insurance industry might be doing?
Yeah, I think it's an industry thing. It's almost very difficult for PSG to influence those decisions. But I do know the SAIA, the South African Insurance Association, they have regular discussion either with the National Treasurer or with SALGA or COCTA. So that is something ongoing. There's also initiatives by different insurance companies on helping the municipalities, especially to deal with flooding areas and helping them with firefighting. So there's also initiative from different insurance companies helping the insurers. So I think it's in our best interest as insurers to help. And I think we maybe not enough, but I think we are helping the municipalities.
There has to be the political will, though, on the other side of the municipal meter, so to speak, to want to work with business. When we look at, and we often talk about the protection gap in South Africa and the fact that, so many South Africans still don't have the right cover to protect against just the basics. And, one of my hobby horses is motor industry third party, which I think should be compulsory. Imagine if it was, it would bring the premiums down across the board, and it would ensure that, people who rely on a bucky, if you're a builder, for example, and you break down, that you can continue your business operations. How much of that is ignorance and how much is simply affordability when we look at the protection gap? And how big is it across the board when it comes to short-term insurance in particular?
Yeah, just to add to what you were talking about, just the making third-party compulsory like it used to be. It will also add 15% to the fiscus because every premium drives 15% VAT. So there's an automatic 15% that will go to the fiscus because of VAT.
Ah,
Yeah, so because every premium attracts VAT, so there's just an benefit, immediate benefit to treasurer because there will be an increase in revenue. The estimate is that only 35% of cars on the road have insurance, and you can see there's quite a big gap. And I don't think, in some cases the protection gap is just because people can't afford it, and you can imagine people staying in informal sector. Insurance is the last resort. But I do think there is also an issue of prioritization and also just making sure that, those people driving cars, I'm sure they can afford at least the lowest form of insurance, especially third party. So I think that one is more of an education because that will always help everyone. The pool becomes bigger, helps the government because there's an increase in VAT collection, and the premium won't increase because the pool is bigger. So there's quite a lot of work that needs to be done in educating and highlighting to people that you've built these assets. Don't protect that assets by having insurance.
It would be interesting to hear Treasury's take on that, or whether or not it would be, because as you say, we used to have it, and it seems to solve for quite a number of different challenges across society. I know it's always a tricky one because you just look at the debate we had by increasing VAT by 1%, and households are under strain. But this is really about building resilience into a household, into a small business. When you look at your book, I'm sure it shows up that South African households are under strain. What is the first thing that people tend to cut? And what's the most dangerous thing that they tend to cut when it comes to their insurance?
And we've seen it in the last 2 years, especially this year, it's a little bit more prevalent. And we see in terms of policies, there's more of RTs, people not just paying a premium. So I think that's the first thing people cut. The motor premium and so on. And you find that when people finance the car, the first year, they have to have an insurance. And then on the second year, then they just cancel insurance. So it's quite a sad reality because accidents do happen and you need insurance and you don't have insurance. But I think that's households are really under stress and they think of cutting costs, then premium becomes the easy thing to do.
Yeah, no, it's again an education story as much as anything else. How are you seeing, and we've seen this huge proliferation of solar panels on rooftops, how are you seeing that come up in the way you insure? Because I'm assuming that people aren't fully apprised of the kind of insurance that they need to see to cover this. And are you as insurers seeing more fire or surge or installation related claims connected to the solar boom?
I haven't come across the increase or the trend as a result of that, but I think solar is still new. And as an advice, we always advise people, if you put something like that, you need to inform your insurers and understand what are their requirements. They might need some certificate from a technician just to be comfortable with the insurance. So as an advice, always make sure that you've informed your insurers and the insurers are comfortable with that. And if they need to price it, and they price it properly. But I've not seen an increase in claims because of solar. So,
that's good to hear. But obviously...
But we're still new. It's still new.
Yeah.
So, yeah.
As that ages, as that infrastructure and that equipment on your roof ages, if you don't maintain it properly, I do think you could be exposing yourself to claims, in the future. I want to come back to the motor side because I think it's really interesting. We also tend to keep our cars for much longer. We've got an aging car park, as they say. And on the one hand, older cars are worth less. On the other, parts can become scarce, and I think the repair time can lengthen as well. Does that mean a relatively minor accident can economically destroy an otherwise perfectly usable older car? And what are you seeing in the second-hand market?
So I think you're right. The shortage of parts and what we've seen, it's just taking a little bit longer to repair a car. So, you see with the car hire extension. So there's an increase in car hire, not because of the client's fault, just because the parts, even for a new one, if you look at the new cars that we're seeing, the import parts are taking longer and the client has to take a little bit a car hire for a longer period. So we've seen that it's taking a little bit longer to repair a car and the cost of that is increasing. But I think that's something that we'll just monitor and see what's happening. It is true that it's taking longer for cars to be repaired. Yeah.
And as we return to the office, through COVID, there was the wonderful benefit was that we weren't driving as much. And so The claims for motor vehicle accidents were down. Have we returned to normal? What are we seeing as we return back to the office? Traffic certainly feels like it's back to normal.
Yeah. I think those were the best years for the insurance company in terms of motor premium because cars were parked and not being driven. It's normal that as you see more cars on the road, there will be more accident. And I think we've noticed the increase in claims for motor vehicles. And last year, we had just a spike in theft, especially for high value vehicle. And I'm sure you might have remembered most insurers insisted that people must put things on their cars just to mitigate against that risk. But there is an increase in cars on the road, and it's normal that we'll see an increase in damage of those cars. Yeah.
And why those trackers, all the telematic stuff is so
Those
important
trackers, yes,
as well. What are you seeing in the reinsurance market? Because it did seem to be hardening. And, there was a sense that local insurers would have to increasingly retain some of those losses. I've read headlines that globally this year has actually seen significant softening in property catastrophe reinsurance pricing. So what are you seeing in the reinsurance market? And would you say South Africa is potentially decoupling from the broader global reinsurance cycle?
We're seeing the same trend. I mean, just post-COVID, most reinsurers, and I'm talking specifically reinsurers, they have suffered losses. They've paid claims. We had floods in Europe and also hurricanes in America. And that carries over the reinsurers. And 5 years ago, reinsurance reached a stage where they said they cannot continue on this one. So see a massive increase in the rates by reinsurers, and reinsurers started imposing higher deductibles, and so on, and really stringent terms. So in the last 4 years, reinsurers have really cleaned up their balance sheet, really healthy balance sheet, which is always good for the insurance industry. And we're seeing the capacity coming back worldwide, not just to the country, the capacity. More capacity always means that we're in the soft market. You can get better terms from the reinsurers. We are at that stage in terms of reinsurance. Since last year, we've seen good terms from the reinsurers. If you've got a good portfolio as an insurance company, you definitely guaranteed a good terms from the reinsurers. Unlike 3 years ago, where you almost knew that the insurers are going to ask for more increases and also higher deductible. And also the reinsurers have increased the attachment point. So most of these floods that we are seeing now will not really affect the reinsurers. It will be borne by the insurance companies because they've demanded insurance companies to take more risk.
That is very encouraging to hear, because ultimately, when it is a hardening reinsurance market, who ultimately absorbs a shock? Well, the local insurers, through having to accept lower margins and their shareholders, but also consumers through higher premiums and excesses. So if we're in a softer market, it is a win-win both for consumers and for shareholders. Just as you look out at some of the emerging risks, one of the big ones we're talking a lot about at the moment is deepfakes and the fake CEO problems. I mean, AI has really dramatically lowered the cost of producing convincing fraud. It really is alarming. And suppose the finance director receives what appears to be a video call or a voice note from the CEO instructing an urgent payment, but it's fake. The money's transferred.
Yes.
Cyber risk has got to be a big one that's increasing. Are you seeing an increase in AI-generated frauds creating losses? And how do you think this might play out over the next 6 months?
I think definitely there's an increase in cyber risk just globally, not just in South Africa. And most people, whether it's companies or individuals, have been affected by this one. And the insurance industry have responded. There's now policies that deals with this one, with this type of risk. And insurance companies also help you in terms of your risk mitigation, things that you must have it. But the intake is still low. And I guess as people understand and see the benefits, the intake will increase. But it's still low at this stage, and most people are still not buying it. Probably, I think it's still expensive and it's something new, but I think it's something that we're going to see more people buying it. It is a worrying risk for everyone.
Who would you say is winning the AI arms race at the moment? Is it the defenders or the attackers? Because you can also use AI to help detect fraud and price risk, but it can also industrialize phishing and social engineering and those deep fakes, as I said.
So I won't talk about attackers, but I'm just talking about the importance of AI for all of us in the industry. If you look at it, the insurance industry, it's an industry where the margins are really tight. You need to manage your cost. And the deployment of AI on your admin, the stuff that is repetitive, that you can really deploy AI easily, whether it's a claims registration or claims payment. So I think that's really to the benefit of all of us. And in some cases, I've seen some insurance companies also using AI to dictate whether it's a real claim or it's a fraudulent claim. It's really something that I think some companies are really ahead on AI, but it's something that we all eventually going to embrace, and it will help us in terms of our cost and whether it's pricing, analyzing, collecting data. It's something that we're all talking about.
I'm glad to hear that we're talking about it. I'm still worried that I don't think businesses are taking it as seriously as they should because of the ability of the attackers to really scale the threat. And I'm sure cyber insurance is going to try and price for that. I don't know how you price for something potentially as catastrophic as a global cloud provider going down, for example. You know, we are so beholden just to a handful of them. And that has got to be a massive risk that keeps you awake at night.
Yes. I mean, there's also risks that currently are not, you can't get insurance for it. And always look at the most risk. I mean, insurance works on the data and ability to understand the data and price it. So where data is not available, you can't price it and there's no predictability. We tend to walk away and on those risks. But overall, I think we're getting more data and understanding the risk. And so there will always be risks that we can't write.
Just one last question quickly, Cedric. Thank you so much for your time. As we reach the halfway mark, it's always a good time to sit down and just kind of review where you are from a risk mitigation perspective as business in particular. What's the one thing that you should be checking tonight if you're in charge of your policies, your business insurance policies?
I think we always talk about that depending whether it's a personal lines or it's commercial, it helps to have a broker because the broker will do that work for you and check whether you're covered or not. But for me, it's making sure that you're adequately insured. You've declared everything, your values adequately captured in the policy. You are not trying to save premium by not declaring the values, because when there's a claim stage and you've undervalued, insurance will always apply what is called average, and that's not in the benefit of you. So for me, if I was a CFO, I would make sure that my policies covered everything through my broker, make sure that the values are properly captured, and reviewing this landscape every 6 months or every 12 months.
Yeah, mind that insurance gap. Great advice. Thank you very much, Cedric Masondo, CEO of PSG Insure. Great having you on the show. Take care.
Thank you.
Well, that was Cedric Masondo, CEO of PSG Insure, with a wrap-up of the big insurance themes of 2026 so far. And that's all for this week's edition of the Monocle Banking Podcast, as always curated by Monocle Solutions. Trust you've been enjoying the show, and don't forget to like, subscribe and share with your network if you have. We'll see you same time next week.